Hello traders, today I'm going to do something a little bit different. I'm not going to be reviewing any trades. I'll do that in my Sunday video. Today I want to focus on a couple of new features that we've added and I want to describe how to use them. Historical volatility is talking about the underlying stock movement. Historical implied volatility helps us understand what's been happening to the option premiums. Those are two new studies that we've added to Option Stalker Pro, so let me show you how to use them. I'm going to go into the daily chart and we're going to select studies. In fact, I've already done that. I'll show you where they reside. And so in studies, if you scroll down, you'll see historical volatility. That's for the underlying stock. And we'll click that and we'll add that. And you'll also see right above it, historical implied volatility. It appears as HIST IV. So let me remove some of the other studies that we have so that our chart is less obscured. And I'm going to remove LRSI and I'm going to remove OneOSI. I don't really need that as well. I'm going to keep OneOP up because I've got another study that I want to show you on that. And so now we can kind of see where we've got the historical volatility of the underlying stock and we have the historical option implied volatility. I can overlay the two of them if I want, but for right now, I'm just going to keep them separate. So if we start seeing that the historical volatility in the underlying stock is not increasing, so it's relatively quiet, relatively flat like this, and we start seeing that option implied volatilities are taking off, then we know that there might be something pending. There could be some uncertainty. There could be news that's coming out that we're not aware of. Doesn't have to be earnings related, but it could be earnings. Earnings reports are going to cause the option implied volatilities to increase because there is uncertainty coming into the picture, and you'll start to see those option implied volatilities expand a week or two before the earnings announcement. So they start building in this uncertainty. And so the stock might be relatively flat, but you see those option IVs start to take off. So let me show you an example. This is a great example. This is JP Morgan Chase. Okay, so you have the stock very, very flat, and you can see that it hasn't gone anywhere. See how the stock is compressing here? But all of a sudden, look at the option IVs. So this is telling us where the current option IVs are relative to where they've been in the past. And we can see that traditionally, those option IVs stay in that 21 range. But now they are starting to take off. And you can see the big drop in JP Morgan Chase this morning. Could it have been that large institutions were seeing a greater chance of earnings volatility this time around than what they've seen previously? Perhaps, because you can see back here in June, we did not have a big spike in option IVs like we're getting right now. So yes, it could have been January, not June. So we didn't have option IVs spiking. You'll also notice that we don't have a lot of historical data on this. We've got about a quarter's worth of data. And so what we're doing is we are currently looking at the money options implied volatilities for both calls and puts. And we're averaging the two of them together so that we have a blended at the money option IV. And we're looking at those for the current month's expiration, and then we're tracking that. And as 1 month expires, we're rolling in to the next and the next and the next so that we have kind of a continuous picture of what option IVs have done. Now, the way that this helps us is that if we're looking to buy options on a particular stock, first and foremost, we can see where those option IVs are relative to a 60-day time frame. Eventually, we'll be able to see what those option IVs look like relative to where they've been for the last year. Are these option implied volatilities relatively expensive or relatively cheap based on where they've been over the course of the last 52 weeks? Now, some stocks, they're volatile. You get these tech names out there, those option IVs are always going to be elevated. So as a general gauge, what I'm looking at, and again, this is general, if the option IVs are above 35, then I'm going to be inclined to be a seller of options. I'm not making a statement that those are expensive or cheap, because really where your option IVs are relative to the 365-day range, that really determines what the option IVs are in terms of expensive or cheap relative to where they normally trade for that underlying stock. But for me, if I see option IVs that are down below 35, it tells me which strategy I'm going to be more inclined to use. I'm going to tend to be a buyer of in-the-money deep options. I'll give myself as much time as I can until expiration. Ideally, I will span that options expiration beyond the next earnings announcement, because those options are going to retain their value better relative to other options where the expiration is before that earnings announcement. And so what this allows me to do is, if the option implied volatilities are relatively cheap, below 35, then I'm able to go deep in the money and I'm able to buy options that are going to have a very high delta. And this is simply a surrogate way for me to trade the underlying stock on a leveraged basis. So when I buy the stock, it's going to be pretty expensive for me to put all that capital out. If I can buy an in-the-money deep call option, let's say I'm bullish on the stock with lots of time till expiration and a fairly tight bid-ask spread, cool. This is a way for me to leverage my capital and to still have point-to-point exposure with the underlying stock. That's what I'm really looking for. On the other hand, let's say that we've got a volatile tech stock and the option IVs are traditionally above 35. Maybe they're at 45, maybe they're at 50. Well, when I'm looking for out of the money bullish put spreads that I want to sell, then all I need to do when I'm clicking through charts is to see where that current at the money option IV is. Really useful tool. So this is a study that you can overlay. And so again, just to recap, it gives us a number of different clues that we should be looking at. One is, where is the option IV currently? Am I favoring buying options or am I favoring selling options? Number two, relative to that range that we have visible, are the options relatively expensive or are they relatively cheap, just based on where they normally trade on a 52-week basis, annual basis? Number three, is the stock flat? So I'm looking at historical volatility and the options IV is starting to increase. If I have this combination, it tells me that something is going on. Now, this particular study is also a variable that we have called IV spike. And so what we've done is we've taken a look at the historical volatility of the stock, and we've taken a look at what the historical IV is. And so we're subtracting these two values and we're tracking the spread. So as the spread starts to expand, meaning stock is flat, option implied volatility is going up. As that spread increases, we assign a orange dot to it. And this is a variable, so if you right click, select edit columns, you'll be able to go down. These are all the variables that you can select from. And you can choose IV spike and add it to the columns. Well, I've already done that, and you can see it right here. So you would just click and add it, and now you have that column displayed. And what this does for me is that if I'm looking through my lists and I see a stock, a holding that I have, and I start seeing that, hey, you know, the option IVs are starting to take off, but the stock is not very volatile, I might want to do some due diligence on it, and I might want to take a look and see if there's some kind of pending news. A few weeks ago, NVIDIA was flagging, and that was because, and you can see, stock relatively flat, 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 but look at the option IVs. They were skyrocketing. Huh? What's up with that? We find out, hey, NVIDIA's got this huge investor conference. This is a huge AI conference, and they're going to be talking about all sorts of new chips that they're coming out with. And so investors who've already been gaga over NVIDIA are super excited now, and they are buying up options like crazy. Market makers don't know what's going to be announced, so they view this as lots of uncertainty, so they back off of the options. They are not willing option sellers, so the option implied volatilities expand. Well, lo and behold, this was a sell the news event, and you can see how the option implied volatilities cratered after this event. What I'm telling you is that if you watch what's happening and you look for these orange dots, they will oftentimes signal that there is danger ahead. They will tell you that, hey, you should be aware of what's going on right now. And then you read about it and find out that there is a conference coming up. Also very important for biotech stocks. Biotech companies have clinical trials all the time. Well, I don't know when these clinical trials are being released. I don't even know when to expect them. But this is going to create a lot of uncertainty around the stock. But guess who knows? The institutions know. The market makers know when these events are happening. It's their job to know. So when you start looking at expensive options, and a lot of people like to just sell volatility, and they go in and they start selling condors or strangles or straddles because they're just doing an option implied volatility search, and oh, this one looks like a really good one. Look at how expensive these options are. I'll just sell them. This is going to give you a warning. Hey, it's not a mistake. These market makers aren't idiots. They know there's an event coming up. Those high option implied volatilities are there for a reason. So the guys that are out there selling straddles and strangles because they're expensive get their head handed to them. And then a day or two later, they find out that, oh my God, there was a clinical trial pending and it didn't go so well. And the stock just lost 25% of its value. Now what do I do? This is a really nice feature, so I hope that you take advantage of it. It's easy. It's just a column that you can have on the very end. And if you've got a position in any of these stocks that have this orange dot, do a little due diligence. Make sure that you know what's coming up. VFC, I don't think they've got any kind of earnings coming out, but the stock volatility is starting to increase, and you can see how it is starting to drop in here. So that's why the option IVs have been increasing without necessarily a big corresponding move in the underlying stock. So could also flag that, hey, you know what? There's a lot of movement taking place, and so they're starting to juice these options up. Another feature that I wanted to discuss was OneOP. Now, I'm going to take these two studies off just to open up the chart a little bit and to show you how to use this. And so I'm going to right click, I'm going to remove studies, and I'm going to remove historical IV and historical volatility. And what we're going to do is we're going to add OneOP. And yes, OneOP can be used for stocks. Now, OneOP has divergences, so it's not just a simple, gee, I've got this bullish cross, that means gaga, go, buy this stock. And here you've actually got a divergence right here. You've got a bullish cross right in here and a bullish cycle, but the stock starts to go lower. So this would be a bearish divergence. Indicator going higher and higher, stock selling off, that would be a bearish divergence. So there are a couple of criteria that we've added to help us really identify when we've got these divergences. And so I am going to put OneOSI back up, because if OneOSI is down and the stock is below the EMA 8, then, and when OneOP is above, when the fast line is above the slow line, this would be a divergence. Okay, this is a bearish divergence, so we would be expecting the stock to go higher. Most of the time it is going to be higher when we have this combination. About 80% of the time when we have a divergence, it tells us that this current trend that is intact is very, very strong, and that there is a shorting opportunity. And so right now I have it marked for a D1 basis, but you can also go in and you can mark this for an M5 basis, a shorter time frame, if you're looking for day trades. So let's go in and take a look at maybe a couple more of them and see where else we might have some bearish divergences. DIA, interesting. Okay, so we've got this crossing on the bullish side, but we've got the Dow relatively weak versus the S&P 500 and below the EMA 8. So yes, that would be confirmation that this trend is fairly strong. Of course, you'd want to beware because we've got the DIA coming up on the 100-day moving average. Let's see if we can pick out maybe another one in here, RIVN, see what that's doing. So here you've just started to get a bullish cross in here, but you've got relative weakness there. You're below the EMA 8. So that's how this field works. And again, you can use this on a D1 basis or any other time frame that you'd like. Let's take a look and see what we got going on the bullish side. Let's see if we can find, the market's down today. So you can see how we are actually making a new low of the day. And we took out a support level right here, which is interesting to me, that we're hanging around for the last couple of days. So let's see what happens in here. We've got a bearish OneOP cross, so interesting. I was kind of painting the picture before I did this video of what might unfold, and we're getting a bearish scenario right in here. So in any event, let's take a look at what's bucking the trend, if anything. Probably not going to be a lot of bullish stocks, but we do have some bullish divergences here. So let's take a look. Oxy is one of those stocks, and here you can see nice compression, nice breakout, market down, stock up. Let's take a look at that divergence right in here. And so we've got just tick below this line right here. So let me take a look on the D1 basis, because that's where we've got this set. So currently we've got a bearish OneOP cycle happening here. This is a bearish cross. When we get that, we would be looking for the stock to head down, for the indicator to head down. But we have OneOSI well above zero, stock well above the EMA 8. So this is a sign that this trend strength is very, very strong. Take a look, BP, okay, yeah, we would expect that. That's another energy stock, kind of the same deal there. So we've got our bearish cross right there, but OneOSI is positive and we're above the EMA 8. Gold also has been a good performer, above EMA 8. Relative strength, bearish cross. So This is going to help you identify those stocks that have a really, really strong trend. I can also put in just a regular 1OP signal. And so I've already described how we're calculating that. If you just want to see which stocks have a bullish 1OP signal or a bearish 1OP signal, you'll also be able to do that as well. So it'll just be another variable. It's another form of confirmation, just like relative strength is a form of confirmation and all the other variables that you can choose from. So wanted to go through, and when you get your watch list set up just like you got all the variables in there, and you like to use a combination of variables. Sometimes you like to include these, sometimes you like to exclude them and focus on other things. Perhaps you've got a different watch list or column layout for shorter term trades and a different one for longer term trades. Maybe you've got variables that you really like on an M5 basis, but they're different when you're looking at a D1 table. You can right click and you can edit columns, and then down at the bottom you can click template, and you can see I've got a couple of templates saved. So you can create a new template, you can name it, and you can save it. Let's say you save it as long term, and another one you might label as short term. This will make it very easy for you to be able to change those templates out. So this is another really nice feature. And so for instance, when I go into my watch lists and let's say that I'm looking at the different sectors, what I like to do is I like to have LRSI as a variable, and LRSI state tells me what the current state is for all those variables. And so right now I can see, this is something that we added previously, but I'll talk about it a little bit because this is a really nice feature, and I'm going to remove some of these studies here. So I just want to keep the bottom of my chart relatively clean so that you can see what I'm referring to. And I'm going to go in and I'm going to add LRSI, and then we'll conclude this video and you'll be able to see how this works. So there's what LRSI is currently doing. And so if I select XLF, I can see that it is solidly below 20. That tells me that financials are weak relative to the market on a D1 basis, and they're weak relative to themselves because LRSI is a smooth way of calculating RSI, but it's different because RSI tends to fluctuate a lot more. This is a smoothing filter that's been applied, and it's stubborn, and then when it cracks hard and fast, and it goes to the other extreme. And these signals are, I find, to be very, very reliable. So when we get movement within LRSI, it's significant. Below 20, it's going to be a solid red. When the underlying ETF or stock is moving from a status where it's been above 80, like here, above 80, above 80, above 80, so this would be green, green, green. Now it's poked below 80. That's when you're going to get a hollow red candle. That tells you that it's transitioning from bullish to bearish right in here. And you can see we've got a lot of sectors that are currently bearish. Okay, as I continue to go down, you're going to see LRSI is green, okay, above 80, solid green, XME, metals, and mining. All right, you can see the strength in that particular sector. So that's how the color coding works. And so we'll find another example where maybe you've got a hollow green. Well, this would mean XLP on a 5-minute basis is actually above 20, but it's a hollow green because it's not above 80. So here it would have been solid green, here it would have been solid red, and in here it would have been a hollow green. So this is still updating. It hasn't caught this last 5-minute bar right in here. But when it updates, it's going to go back to a solid red. So now all of a sudden I can start to see kind of what's happening with all these different sectors. And what I'm seeing is that there's a lot of weakness out there, with the exception on a D1 basis of the energy stocks and the metal stocks. Most of these sectors are down, and they are down pretty dang solidly. Some of them are already red, below 20. Some of them are transitioning that way. So those are some new features. I think you find these very, very helpful. Give them a try. This historical implied volatility, I got to tell you, I really like using this one. And so when I'm flipping charts on a D1 basis, and you only will be able to see it on a D1 basis because it's the only place that it's really relevant. It's calculated on a D1 basis. We're not using real-time option data to calculate it intraday. But what this allows me to do is I can instantly flip through a bunch of charts, and I'm going to do that right now, and I can tell right away, am I going to be leaning on a buying strategy for this stock, or am I going to be leaning on a selling strategy for this stock? So we'll just go into red royal flush, and we're just going to start clicking through some charts and looking. And so here on Adobe, I can see this crackdown. I can also see that these option implied volatilities on Adobe are quite inexpensive. This is what they do historically. So on this type of range, these options are pretty dang cheap. What about Lulu? Yeah, they're pretty dang cheap relative to where the options have been for Lulu. Keep going down the list. Crowd, relatively inexpensive based on where they've been previously. So option implied volatilities have been pretty cheap. Here's one on Baidu where you can see the option implied volatilities are actually pretty expensive. So on a relative basis. So I may not be as inclined to buy these put options if that's my strategy because they're relatively expensive. And in all instances, okay, option implied volatilities above 44, probably going to be favoring a selling strategy, like selling an out-of-the-money call credit spread. Options below 35, I'm going to be more inclined to use some buying strategies. So here you would have relatively inexpensive options. So that's how we would use it. Boeing, you can see kind of middle of the road, but those option implied volatilities are starting to pick up, but they're still at 34, so relatively cheap. I can be an option buyer in here. I think I've given you enough examples. That's how we use historical volatility for the stock, historical implied volatilities for the options. The spread between the two indicates if there's some danger, so we use the IV spike column, and we look for those orange dots to signal that there might be possible news pending that we're unaware of. We also use the historical IV to tell us if we should be leaning towards selling strategies if the option implied volatilities are historically very high, and we favor buying strategies if those option implied volatilities are relatively cheap, below 35. And then I've also shown you how we can use the column layouts and how we can save those across different time frames, or perhaps you even have different sectors or groups that you have different variables for. Thanks so much for watching. Please leave your comments if you have any questions. We'll see you Sunday. I'll be doing a video recording then. Thank you.
Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education, so make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.